Welcome to Power of the Dollar YouTube channel where we discuss all things finance. Today's video is going to be all things mortgages. We're going to get into where mortgages are right now, where I think they're going to go and where they've been, how inflation and unemployment, how those two are related and influencing the Federal Reserve into raising rates and cutting rates, and how we can look into where the Federal Reserve is thinking and what investors are predicting will happen with rates. And how I also don't think there's going to be a housing crash. So be very careful of clickbait out there. You see these videos, crash this, crash that. We're going to get into the weeds of it all today and how you can make decisions like that for yourself. So first up, I like going to CNBC every morning. Let me refresh this. The stock market got crushed yesterday. The Dow futures were down over 1,200 and not looking like a very good recovery day. I'm not sure why. It's actually moderately flat given yesterday. In Japan, the stock market was down over 12% for the futures. Actually, I think in total for the day, it was down over 12%, and they've recovered over 10%. So they've made remarkable gains back where the U.S. wasn't down 12%, but hasn't gained back that much. So something to keep an eye on. So let's go to mortgage rates. I'm going to show you this right here. So this is mortgagenewsdaily.com. This website is free. And this right here is a chart of a bond that's sold on Wall Street. And this bond is for mortgage-backed securities. And like anything, when people want to buy, prices go up. When people want to sell, prices go down. So when prices go up on a bond, the yield or the interest rate comes down. So you could see here in the last few weeks, the last few months, the price of this bond right here has gone up quite a bit. And that means mortgage rates have come down quite a bit because this bond is linked to mortgage rates. So that's how this chart works and what that means. Here are the actual mortgage rates themselves. Coming back to about a year ago, mortgage rates were really on the move. They made a peak at 8%. I think it was 8.03. Then they made their way back down. And then in the springtime, there was a little bit of an uptick in inflation. It really spooked the markets out. People thought interest rates from the Federal Reserve standpoint were going to remain higher for longer. So you could see mortgage rates went up to 7.5%. But now with unemployment numbers coming in worse than expected, with employment numbers coming in worse than expected, and inflation numbers coming in right on par about where the Federal Reserve is expecting them, not too far off from their 2% target, people are now expecting the Federal Reserve to start cutting rates. And in that anticipation, even though they didn't cut rates last week, people are anticipating rapid, aggressive movements from the Federal Reserve to cut rates to make sure the economy doesn't sour too badly. So you can see here mortgage rates have just fallen off a cliff. Anyone who bought a house in the last year probably getting close to a refi. I know a lot of people that are looking for refis, and if you bought back here with an 8% mortgage, you're probably very happy to see this coming down. But don't forget this, most buyers don't have mortgage rates this high. Most buyers are 4 and below. We'll talk about that at the end and how this is all going to be related to why I don't think there's going to be a housing crash. So how does the Federal Reserve, how do they work? What do they do? What's their job? The Federal Reserve is in control of all the money. This is on the Fed's website right here. They're in charge of all the money and basically keeping the financial system stable. So they have a dual mandate. This is right on the Fed's website. Their dual mandate is two things: price stability and maximum sustainable employment. So they want to keep prices going up at about a 2% clip year over year so that it's predictable, so that it's not too bad. And then 2 years ago, we had inflation over 8%. That was real bad. People were getting crushed at the grocery store, gas pump, you name it. So the Federal Reserve raised interest rates to try and keep those prices down, try to get them back down to a 2% year over year increase. But unemployment is starting to work its way up. So now they're starting to think about their second mandate, maximum sustainable employment. So prices are starting to come down, inflation is starting to come down, and unemployment is starting to tick up, which means that their current interest rate setting of 5.5% right here might be too restrictive. So people are predicting that they're going to start dropping rates. So this is from the Federal Reserve Economic Data website, the FRED. This is all free to access. Everything I have up here is free to access. And this shows the Federal Reserve's benchmark rate for decades, going back to the 50s. And in more modern times here, you could see this is when COVID took place in this gray shaded area that always shows a recession. Interest rates fell off a cliff, and then subsequently mortgage rates went down to below 3%. But as inflation, we'll go right here. This is another free chart on the Fed's website. As inflation ramped up to over 8%, it went 4.7, 8%, and was still above 4 last year. The Fed said we have to do something. Unemployment's very low, so we can start to raise rates to combat this inflation here. So they've raised rates, and now with unemployment starting to go up and inflation coming down, people are expecting this benchmark rate to start falling. So let's go to Forbes.com. Once again, this is all free stuff. This is on Forbes, a well-known finance website. Let's see right here. Is 2024 a good time to refinance? And I like this right here. Over 40% of mortgages originated in 2000. Over 40% of U.S. mortgages originated in 2020 and 2021 when these rates were at record lows. So most of these mortgages were when people were out there buying during that housing frenzy, where people just wanted to get out of the city, they wanted to get to the suburbs, they just wanted to get a house of their own. They didn't want to rent anymore. They didn't want to be stuck in an apartment building. They just wanted their own single-family house or condo. So the demand went absolutely crazy for people buying their own properties, which drove the prices up. And when interest rates were very low, it drove the prices up even further. So many of these mortgages were created in the last few years at record lows. Also, 14 million people refinanced during that same time. And that's going to take me to this part right here. Check this out. Interest rate at origination. Almost 30% of mortgages are below a 3%. 33% are below a 4% to the 3% range. And if you add these all together right here, it's almost 60% of mortgages are at 5% or below, which means most people can't even refinance right now because their current interest rate is better than what's out there. And with mortgage rates this low, when people were able to refinance to these lower rates, they got a lot more breathing room in their month-to-month payments. On maybe they went from a $3,000 a month payment with a 4% rate, and they were able to refi down to a 2.75, and were able to get that payment down maybe $400 or $500 a month. So that gives a lot of people a lot of breathing room when they were able to refinance. And with unemployment still quite low, even though it is ticking up, I don't foresee a housing crash here. And let me tell you why. People's mortgage rates are very low. Unemployment is still low. How do you increase? The only way that a housing crash is going to happen is if tons and tons of houses start hitting the market. And that's not going to happen with rates this low and with unemployment this low. And let me just go show you something right here, okay? Fed funds rate, let's go back to 2008. And I'm going to pull up this chart right here. Fed unemployment. Little history lesson here. So let's go to 2008. Here it is, 2008. So unemployment was very low in the mid-2000s. It was on its way down after a small recession back here. Unemployment was low, hit 5, 4, and it was just above 4. And right around this time, interest rates, so this is 2006, 2007, 2008, interest rates back here, 2004, 5, 6, and then 7, interest rates from the Federal Reserve were going up because inflation was going up. And most people who were buying houses back here, they had what was called adjustable rate mortgages. And the rates for those mortgages would adjust month to month based on what the current Federal Reserve interest rates were set at. So anyone who got a mortgage back here might have been $1,000 a month, and then it crept up $1,100, $1,300, $1,600, $2,000. Eventually it became unsustainable. People had to foreclose on their houses. It was a huge tidal wave of houses hitting the market. And when there's tons of demand, tons of supply, and not so many people in demand because it was a recession, you could see right here, housing prices came down. And I'll show you this right here. Case Shiller Fred. Right here, this is going to show housing prices. And right here, housing prices started in 2007 actually came down, and that's because there were so many houses on the market, huge recession here, no one was out there to buy, so housing prices came down naturally. So that's why I don't think housing prices are going to come crashing down. I don't think there's going to be a housing crash. The only way there's going to be a crash like this is if houses hit the market. And with interest rates so low down here and unemployment low, I couldn't foresee, unless some canary in the coal mine that many of us aren't aware about, I can't foresee a major sudden housing crash happening. But that's just my take on it. I'd like to hear your opinions. And with that being said, that's all I got. Thank you for tuning in to Power the Dollar YouTube channel. Please toss this video a like and subscribe so you can be notified of all my upcoming videos that I have in the pipeline. And like I said before, if you have any questions or comments, drop it below. I'd be glad to answer them for you. And I'll see you next time. Thank you so much.